Today, to start the show, in a matter of few days, your employer may roll out your Diwali bonus, or if your salary was delayed, then by now you must have received it. Whatever be the scenario, how should one use this extra cash payout? All of us usually tend to send this on our lifestyle needs, like shopping or going for a movie or having a long list considering the festive season. But is there any other prudent way to make use of your bonus? To help you get tips on how to utilize your Diwali bonus or salary increments, we have on board Santosh Navlani, CEO, ET Money. Santosh, good evening and welcome to the show. So it's bonus time, salary increment time, a lot of good news coming in. How should one, a lot of people actually wait for this time, because they've either got a big ticket purchase that they want to use this money for, or maybe a major chunk of their liability that they really want to get rid of. What, according to you, should be a strategy? How should one decide a strategy for this extra cash flow that they might get now?
Hi Kavita. Yeah, so I think it's a wonderful time to be expecting any kind of extra bonus, extra salary, or this Diwali extra cash that you might get from sources which can range from your family to your employer. And I think many of us end up spending that money in an impulsive manner and not really be thoughtful about what we can do with that money to improve our financial lives for the long run. And if you actually kind of be a little more thoughtful about if the amount is significant for you, then it can actually do a lot of wonders to improve yourself. And one has to find ways, depending on one's financial situation, what the best use of that money. It can actually range from paying off debts to basically making better investments. I think we can discuss all those possible options. But what you should not be doing is let the money lie idle as well if you don't spend it by earning like just 2.5%, 3% interest rate on savings bank account. Even that is like doing more harm than good to your money. So we can discuss all the options and kind of actually make use of this money far better.
So let's get on with that. And what, according to you, will be the first step that one should be considering as far as the financial planning is concerned, or getting their finances right when they get this big chunk of money?
So I think one of the most prudent use of extra cash, Diwali bonus, annual incremental cycles. I think everything applies to this answer. Is actually getting rid of your debts that you may have, or actually prepaying a certain amount of loan that you may have. It can be even increasing EMI if you're expecting this to be an annual affair for yourself. And I think most people don't realize that if they're able to kind of tick off those EMIs or the burden of a loan, it can actually do a world of good to your financial lives. And just take a simple example. Even if you are looking at a home loan, which is one of the cheapest form of loans that an individual can actually take, a 50 lakh rupee loan and at an 8% of annual interest adds up to almost 50 lakh rupees of interest payments over 20 years. And if you are able to actually take off by prepaying every bonus that you get every year, you may be able to take off that loan liability in a matter of 10 years instead of 20. And the savings can be substantial and not just 25 lakh rupees, because most of the initial years of your EMIs go towards servicing interest. So idea is, if you can actually use to pay off your loans, if you have any, it's one of the best use that you can do. And I'm only taking example of home loan here. If you are able to kind of do it for your personal loans that may be at a higher interest rate, 14% or so, or a car loan that you may be having, which is 10% or so, if there are no prepayment penalties, I would actually suggest take off the debt which is at a higher interest rate than anything first, and basically apply to credit card debt as well.
Tell us something. How does one, so for example, if someone has a huge loan portfolio or liability portfolio, how should one decide what should go off that list first?
I think there are multiple ways to look at it, Kavita, but I think most prudent way would be taking off the loans which are on higher interest rates. So Typically, a personal loan will carry a highest interest rate of maybe 14%, 16%, 13%, depending on your credit score and your income levels. A car loan may be in the region of about 9 to 10%. A home loan, as of now, may be in the region of 8 to 8.5. So I would actually say that you should tick off the loan which is on a higher interest rate, because it's a cost that you're actually incurring, and that cost is not small. So pay off the loan which is the highest interest rate, and of course the stack rank in my opinion is credit card, followed by personal loan, followed by car loan, followed by home loan. And if you actually are not comfortable, because there is a prepayment penalty on it, and sometimes there is a significant penalty associated, at least in terms of personal loans and car loans, then you should basically look at home loans, because home loans don't carry any kind of prepayment penalty. So you actually end up saving that money as well. So look at your loan conditions, terms and conditions of your loan documents, and the interest rate, and take a judicious call based on that.
Right. Now let's talk about emergency fund, which is actually the first step of your financial planning. That ideally should be the first step, and a lot of people really miss out on this very important planning. Can one actually use this money to create a contingency fund?
Of course. So I think if you're somebody who actually doesn't have kind of emergency fund yet, I would actually recommend that prioritize building an emergency fund over paying off your debt, because emergencies by definition can come unannounced. You may not be prepared to handle them. You may have to take another debt to basically overcome it. And having an emergency fund is far better financial planning than actually not having one. A lot of things happen in times which are unplanned expenses, which may be surprising at times. It can be in form of medical emergency, it can be in the form of any kind of other expenditure that may come in the family, and it is such that is unavoidable. There is no way you can opt out of that expenditure, and hence emergency fund actually helps a lot. I would actually prioritize that over paying off your loans. And if you want to kind of have a rule book, what kind of emergency fund you should have, it can actually be depending on how stable your finances are, how stable your monthly savings are, what kind of income levels you are earning, and what kind of monthly expenditure you are having right now. It can vary from as small as 3 months of your monthly expenditure as emergency fund, or it can be as high as 12 months of emergency fund. If you're a professional not having any kind of regular income, then it may be better off to have a 12-month emergency fund. But if you're salaried individuals, for most people, I think 6 months will just fit in fine.
What should be the strategy for actually starting off with the emergency fund planning? How should we plan on the route of investment, Santosh? Okay, the money that we've got could be in bulk. Okay, so does it make sense to do an STP, or should one just really park this bulk money in a liquid fund? How should one go about it?
Yeah, so I think you hit the thing on the bang on, Kavita. I think the second question people actually may end up having is, where do I build this emergency fund? Should I be building this as a part of savings bank account, because one of the most liquid ways to withdraw money if and when you want. But because emergency fund investment tenure can be indefinite, you would not know, and you would actually not want to use that money forever in that sense. It is better that you keep that money in liquid fund, because liquid fund actually would possibly always earn more than a savings bank account interest rate for at least most of the banks that you are able to open accounts with in the country. So I would say that you should park that money in liquid fund or a one-night fund if you really want to be super safe about it. They would typically earn about 5 to 6% annual yield as per current interest rate scenario in the country. If the interest rates rise, you might end up earning more as well. And of course, because emergency fund is such that you may not need for next 4 years, it will actually have indexation benefits as well. So instead of actually looking at bank account as a possible source of this money, you should only look at liquid and overnight funds as first option for yourself in terms of parking that money.
All right, let's move on. Now, the next step, according to you, is to plan your tax-saving investment. Now, that is something very relevant and very timely, also because you can avoid the last-minute deadlines if you plan it that in advance.
Yeah, Kavita, most people actually end up taking wrong decisions by copying the option that their friends has taken or colleagues have taken, and they just mindlessly buy those products as well. And one of the ways to avoid that is be more planned about it. What happens with an annual increment or an extra cash or a bonus which comes your way from your employer? It basically increases your tax liability, and there is no way you can wish it away. But you can actually work towards decreasing the tax liability that you may have. And if one of the fastest or easiest ways is to be basically putting that money to good use in the form of tax saving investments. And there are very easy ways to do that. I think ELS's equity link saving scheme in mutual funds is one of the best ways to create wealth for long run, and also have the smallest kind of a lock-in period for your investment, just 3 years. So you should maximize that thing. If you have not used the entire Section 80C available to you, which is 1.5 lakh rupees annually, you should first max out that thing. And there are other options in the form of NPS as well. If you are somebody who's looking to really park that money for long-term investments towards retirement, NPS hands becomes a very good option as well. So I would say that first emergency fund, second is pay off your debts, and if you don't have needs of doing both the things, look at the third option, which is actually reducing your tax liability of the increased income.
All right, a lot of tax options over here give the feasibility to invest in lump sum. But if at all one is running short, even in that, a major chunk can be paid during this period and later on can be done in the coming months. If one is not able to finish this entire plan in one go, how should one go about it?
I think so. Tax saving investments is such, Kavita, at least with respect to products which are suitable to investors for long-term wealth creation, allow monthly SIP options. So ELSS funds allow monthly SIP options. NPS allows monthly SIP option, at least on ET money. Sometimes if you are buying investment-oriented insurance policies, which actually you don't recommend at ET money at all, even those provide monthly options to you. So if you are not able to max out that amount and you are falling short, it's always recommended that you start whatever you can afford today and be able to afford for next few months, because you can actually claim that entire benefit till March. So if there are 6 months remaining, 6 installments that you can actually make up to meet your tax liabilities or tax saving investments, do that. Start an SIP which you can afford and continue till the March or maybe forever in that sense, so that even next year's investments are taken care of.
Next is obviously you need to increase your investments if at all you can, but then tell us something about insurance. How can one get more insurance cover or get their risk or liabilities covered properly in terms of getting the right insurance cover for themselves?
Yes, so I think, Kavita, many people look at insurance as an expense which they always would want to avoid and not take up that liability on themselves too, because good insurance policies like term insurance and health insurance would actually have annual recurring premiums in the form of renewal premiums for health insurance and annual premium for term insurance. And if you've been someone who's been avoiding that, then considering protection for yourself is a very good use of that money. It also saves tax, by the way. One of the healthiest form of saving taxes, in my opinion, is buying a health insurance policy for your family and yourself. So consider having a health insurance. If you actually have health insurance, which is one of the first insurance you should buy for yourself, then look at your term insurance requirements. Are you fully covered? And in India, being an underinsured country, most people are underinsured compared to being overinsured. So look at review your insurance cover requirement. If you are not insured so far in form of life insurance, consider buying a life insurance policy, and take an annual premium option if you're expecting this annual bonus or Diwali bonus, which is coming your way as a regular feature every year. So you can actually time your annual insurance premium payments around the same time next year, so they're able to afford it easily as well. So buying health insurance and protection for yourself is one of the best use you do for your money, which you're coming right now and expecting your bank account right now.
Got it. So this is the right way to utilize your Diwali bonus or that extra income that might just come in your hand during this festival season. And that will be all in this bit. Santosh, thank you so much for joining in.